All right, let's talk about Chemours. They just reported their Q4 earnings, and wow, the market absolutely hammered the stock. So, the big question on everyone's mind is simple. What went wrong? Was this sell-off justified, or is this a massive overreaction? We're going to dig in and find out.
And boom, here's what that looks like. A 16.5% drop in one day. We're talking huge volume here too. So you know this wasn't just a little bit of profit taking. No, this was the market basically saying, we don't like what we see. It was a flat-out rejection of the results and, maybe even more importantly, their outlook. So let's get to the bottom of it. Why the huge drop?
So that's the million-dollar question, right? Is the whole growth story for Chemours officially broken? Or is this just a bump in the road, a temporary setback? In this explainer, we're going to tear apart the numbers. We'll figure out if this was just a one-off bad quarter or if it points to some deeper issues. And of course, we'll talk about what it all means for the stock.
Okay, first up, the headline numbers. Let's look at exactly what caused all this chaos. So if you look at the top line, the revenue, it was actually fine. I mean, basically right in line with what Wall Street was expecting. But that's not where the story is. The real problem was on the bottom line. That adjusted EPS number came in at 5 cents, when the consensus was 7. That 2-cent miss was the big red flag. And when you pair that with a 24% collapse in adjusted EBITDA year over year, well, you get a really ugly picture of profitability just shrinking away.
And here's the thing. If you listen to the earnings call, management really tried to focus everyone's attention on free cash flow. And to be fair, they generated a solid $92 million. But it just didn't matter. Investors were laser-focused on that EPS miss, the weak profits in some of their business lines, and, as we're about to see, a pretty soft guide for the next quarter. The market just wasn't buying the good news.
All right, so to really get what's going on here, we have to look under the hood. It's really a tale of two different companies inside of one.
You see, what's happening is a real tug-of-war between their different businesses. On one side, you've got the growth story, their specialty chemicals. This is the good stuff. But it's constantly fighting against these major headwinds coming from their legacy businesses.
And this chart right here, it just says it all. I mean, look at this. You have the TSS segment, the good part of the business, up a respectable 5%. That's your bright spot. But then Titanium Technologies is down a staggering 67%, and APM down 74%. This isn't just a little softness, folks. This is a complete collapse in profitability for 2/3 of the business.
So what's driving this? Well, TSS is really the hero here. Their Opteon refrigerants saw sales jump 37%. That's all thanks to new regulations like the AIM Act in the US that are pushing people to switch to these newer, better coolants. But the other two businesses, that's where the trouble is. Titanium Technologies, or TT, they make TiO2. Think of it as the white stuff in paint. It's super cyclical, tied to things like housing, and that market is just weak right now. Then you have APM, which got hit with a double whammy, a big facility outage that management said cost them something like $20 to $25 million. Okay, so Q4 was a mess. We get it. But honestly, what really sent the stock into a nosedive was what they said about the future. So let's talk about the guidance and management's big plan.
This right here was pretty much the nail in the coffin for the stock on earnings day. Management guided Q1 adjusted EBITDA to a range of $120 to $150 million. Now, to you and me, that might just be a number. But to Wall Street, that was way, way below what they were expecting. It basically confirmed everyone's worst fears. The problems we saw in Q4 aren't going away anytime soon.
Now, the funny thing is, their full-year outlook actually looks okay. They're guiding to $800 to $900 million in EBITDA for the full year. But here's the catch. To get there, they need a huge recovery in the second half of the year. And the market is just deeply skeptical. This has become what we call a show-me story. Management is saying, trust us, it'll get better. And the market is saying, yeah, we'll believe it when we see it. Right now, that trust is pretty low.
So part of their comeback plan is to get their financial house in order. They laid out a really clear 3-step plan to get their debt down. Step 1, keep generating that free cash flow. Step 2, sell off a facility they have, the Kuan Yin site, which should bring in around $300 million. And step 3, use that cash to get their net leverage down below 4 times by the end of the year. This is absolutely critical if they want to get investors back on their side.
All right, so let's put it all together. What's the final verdict? Is this stock a buy, a sell, a hold? Here's our take. We're calling this one a market perform. Look, the bull case here is real.
That Opteon growth, especially with all the buzz around AI and data centers needing more cooling, that's a fantastic story. It's absolutely compelling. But, and this is a big but, it's being completely drowned out right now by the weakness in their other businesses and these operational screw-ups. The potential is there. It's just buried under a lot of near-term problems.
So if you're watching this stock, what should you be looking for? We've got 3 key catalysts. Number 1, they need to get that Washington Works facility back up and running smoothly, no more surprises. Number 2, we need to see if the price hikes they're putting through in their TiO2 business actually stick and help their margins. And number 3, this is the big one, we need to see proof, hard data, that the growth in their TSS segment is powerful enough to overcome the drag from everything else.
So with all that in mind, the show me story, our market perform rating, how could you actually play this? Let's talk about one potential trade idea. Okay, so here's the pitch. It's all about betting on short-term pain but long-term gain. The idea is you could sell some near-term call spreads. That's basically a bet that the stock is going to tread water or maybe even drift a little lower for the next few months while things are messy. Then, you take the money you make from that trade and use it to buy longer-dated calls. That's your bet on that second-half recovery story we talked about. It's a way to say I believe in the long-term story, but I think it's going to take a few quarters to play out.
So there you have it. That's our breakdown of Chemours. The big question is this a classic value trap, or is this a coiled spring getting ready to bounce? And of course, I have to say it, this is not financial advice.